let's start off talking about the markets. We are in a very, very interesting time for the markets where we're witnessing a crash in both stocks and bonds right now. Something that I haven't seen in my 40-year career. I don't think I recall it being this bad. And I think it's going to get worse before it gets better. We're seeing the stock market on Friday was down almost 1,000 points. Early in the week, it was almost down 1,000 points again. Every little rally that comes in is sold into. We are in the midst of what's the beginning of a very, very ferocious bear market. And we'll talk about why that's happening and why we believe it's just the beginning of things. It was announced on Friday, very big surprise, that the GDP, the gross domestic product, the economy of the United States, unexpectedly shrunk 1.4% in the first quarter of this year. Economists expected to see it up 1.1%. Now, this is on an annual basis. Okay, so it's not just a quarter went down 1.4, but on an annual basis. So it makes sense. I mean, we got rampant inflation. We got the Fed raising interest rates. We have geopolitical instability. We got domestic political instability. We got a lot of things going on. It's certainly a recipe for lower stock prices and a shrinking economy. So the economy shrank 1.4%, surprised everybody, and it didn't surprise me. I mean, I told you, the economy is weak. The financial press and the political establishment want you to think that the economy is just fine. It's not. And the GDP reflected it. And you got to realize, all these numbers that come out of the government are a lie. You know, they're massaged, they're changed, they're messed around with to look better than they really are. So, you know, it's probably worse than that. Whether we're talking about inflation, we're talking about unemployment, we're talking about the GDP. Don't trust anything that comes out of the government. And, you know, they're talking about this new disinformation bureau that they want to come out. Everything that you hear is disinformation. Everything is a lie. All right, we'll talk about that later in the program, how everything is a lie. So now they want to put this disinformation bureau, so anything that's truth could be suppressed. And that's what it's all about, and we'll get into that probably in the second hour later on. So the Federal Reserve meets this week. They're going to raise interest rates, most likely 0.5 percentage point, which will make the federal funds rate close to 1%, between 0.75% and 1%, which is nothing. If they really want to battle inflation, they're going to have to raise the federal funds rate to at least 10%, which would destroy the financial markets, would destroy the real estate market, which would destroy the economy, which would destroy the banking system, because the Fed can't do it. But it'll be interesting to see how the markets react to the Fed's meeting. And more importantly than what the Fed does, it's what they say they're going to do in the future that's most important. Markets want to hear what they're going to do down the line. It's baked in the cake right now that the Fed's going to raise interest rates 0.5 point. Now, there's a chance they may raise it 0.75 point. Market won't like that because they're expecting 0.5 point. So the Fed will come out, they'll announce their interest rate increase to battle inflation, which will do nothing to battle inflation. The markets will react most likely negatively. Now, some are saying, okay, well, you know, once the Fed announces this, it's behind us, the markets may rally from here, and maybe it'll be a short-term rally, who knows. But more importantly, the markets are going to look into what the Fed says going forward. Are they going to be more aggressive in their interest rate increases? And that's the last thing this market can handle is higher interest rates, because if you understand anything about markets, low interest rates, free money policy, quantitative easing, the printing of money, all these things that have been taking place for the last 12 years are very bullish for the market. When you reverse that, when you take the punch bowl away, when you take interest rates and start raising them, when you stop printing money, which, by the way, the Fed's not going to do, it's the opposite effect. Stocks go down. And that's what we're seeing now. It's basic market theory. Right? Low interest rates, declining interest rates, stimulative policy, government fiscal spending, like the stimulus programs that we've seen, like all these printing of money, giving checks to everybody. All that stuff is Stimulus to the economy, a stimulus to the market. The money has to find a place, it has to find a home, and it found it in the market and made stock prices outrageously overvalued. And we've been saying on this program for months that you got to lower your exposure in the market. These are dangerous markets right now. It's very important that you understand that. And so many people are overexposed to the stock market. I'm seeing it every day in my practice. People are retiring now. They show me their 401ks. They're 85% in the market. I go, are you crazy? Just prior to retirement, you have your money on red or black on the roulette table. That's crazy. The market is one giant casino right now. It's one giant gamble right now. And yesterday, big news was that Warren Buffett, who's the CEO of Berkshire Hathaway, one of the best investors of all time, he has a meeting in Omaha, Nebraska every year, and it's a big deal what Buffett has to say about the economy and about the market because he is such a successful investor. And he said yesterday, the market is worried about a very fragile economic outlook, as it should be. And he went on to say that he said he was lambasting Wall Street for encouraging speculative behavior in the stock market. And he said it effectively turned the market into a gambling parlor. He also announced that Berkshire Hathaway suffered a $1.58 billion loss in the first quarter of 2022. And that's very unusual for him. But why wouldn't he? I mean, the quarter was horrible. And he was criticizing Wall Street. He was criticizing investment banks. What else did he say yesterday? He said, Wall Street makes money one way or another, catching the crumbs that fall off the table of capitalism. They don't make money unless people do things, and they get a piece of them. They make a lot of money when people are gambling than when they are investing. Buffett went on to bemoan the large American companies have become poker chips for market speculation. So he's saying basically right now that the market is not real, valuations aren't right, and that people are just gambling. Now, his partner, Charlie Munger, who's 98 years old, I mean, what is Buffett, 90? This is like his older brother at 98. The guy's still working. He chimed in and he said that it's almost a mania of speculation. We have people who know nothing about stocks being advised by stockbrokers who know even less. That tells you a lot. Most stockbrokers haven't really lived in a bear market. They've been in the business less than 10 years. They weren't even around in 2008, most of them. Being a stockbroker is pretty much a young man's game because of the stresses that go with it. Now, I've been a registered stockbroker for almost 40 years. I've lived through many bear markets, many crashes. They're no fun. Being responsible for people's money, it's not a lot of fun when you're in a bear market. But he goes on to say, Munger, and he knows better than anybody. He's 98 years old. He's been around longer than I have. He said, we have people who know nothing about stocks being advised by stockbrokers who know even less. And he's absolutely right. It's an incredible, crazy situation. I don't think any wise country would want this outcome. Why would you want your country's stock to trade on a casino? So this is Warren Buffett and his partner basically telling you the market is a casino. So let's look at the stock market this week. It's just getting worse and worse and worse. It's starting to get panicky. It's crashy. I don't like the way the trading has been this week at all. The Dow Jones Industrial Average for the week was down 2.5%, and that's the best index of them all. For the year, the Dow's down 9.25%. Friday, the Dow was down 939 points, or 2.7%. And the problem with Friday is that the market closed really bad. I mean, in the last hour, it dropped another 300 points. There was no bounce. all day. The S&P 500, which is a more broader index of stocks, down 3.27% for the week, down 13.3% for the year. Now, we're talking 4 months here. We're talking through April. It's May 1st, so we're talking the first 4 months of the year are in the books. NASDAQ is down almost 4% on Friday, down 21.6% for the year, and down 4.17% on Friday alone. So these are tremendous declines in the market. And normally, when you see stocks down, a lot of people say, "Lou, isn't bonds supposed to go up when stocks go down?" No, not necessarily. Not necessarily. The theory is if stocks are going down and people are selling speculative assets like stocks, they're going to put the money in safe places like treasury bonds. But that's not happening now. As a matter of fact, the reason why stocks are going down is because bonds are going down, interest rates are going up. As I said before, rising interest rates are not good for markets. Not good for the stock market, not good for the bond market, not good for the real estate market, not good for the economy. And that's why stocks are going down. Not to mention the Ukraine problem, the inflation problem, everything that's going on. So we're in the middle of it's a correction. You can call it a correction. You can call it a crash. It's over 10%. Once you get over 10%, it's called a correction. Once you get over 20%, it's called a bear market. The NASDAQ is in a bear market. And I expect more stock market pain to come. And some people I follow out there, you know, the S&P 500 is right around, 4,100, something like that. Some people are expecting a decline to 1,800 to 2,000, which would be another 50% from here. And you know what? If it went there, the price to earnings ratio of the stock market would be fair value. It wouldn't be undervalued there. That shows you how overvalued the markets are. Now, what the Fed's trying to do is engineer what's called a soft landing. I always love that statement. A soft landing simply means that they're going to try to lower the economy, lower inflation, but not cause a recession. Soft landings almost never happen. The definition of a recession is 2 quarters of negative growth. So we have the first quarter of this year down 1.4%. If the second quarter is down as well, we're in a recession. And politically, this is a terrible time for a recession for the Democrats. You don't want to go into a midterm election with all the problems the Democrats have, which we'll detail and document later in the program, to have the economy tanking at the same time. Not good. Oil prices remain elevated, 104 a barrel for oil this week. We're seeing gasoline prices that briefly went below $4 a gallon, rising again. I think I saw 4.17 at my local Wawa on the way in today. The 10-year Treasury bond, 2.94%, which is a high on this move. It's going higher, the yield. You know, the 10-year Treasury bond is down like 20%. I've never seen such declines in bonds like I'm seeing now. I was looking at the Vanguard long-term U.S. Treasury bond fund, down 17%. Maybe a little less than that, 16 and change. I was looking at the Fidelity corporate bond fund. It shows you what's going on in the corporate bond market, down 12%. I mean, these are huge moves in bonds. Interest rates go up, bond prices go down. Bond prices go down, interest rates go up. Gold, which is having a terrible time getting any traction. Every time it hits 2,000, it's manipulated down. Closed under 1,900 this week, 1,896. Ridiculous. Gold should be twice what it's trading at. Silver, even worse, 22.75 an ounce. I mean, it's ridiculous. I mean, silver's all-time high is $49.50. It's not even half. And meanwhile, the debt of the country is just skyrocketing. The money supply is skyrocketed. It was 2011 when silver was 49. Also, cryptocurrencies taking gas lately. Bitcoin's down to 37,000 and change. It seems to be following the NASDAQ. Mortgage rates this week hit 5.10. I've even seen 5.30 on some mortgages out there. So obviously that's affecting the housing market. Here's a headline. U.S. new home sales crashed in March. Analysts expected a third straight month of declines in new home sales in March, but they did not see this bloodbath coming. New home sales crashed 8.6% month over month. Economists expected a 0.6 decline. It was 8.6. And new home sales are now down 12.6% year over year. And you know, April's like the busiest season for housing. It's the beginning of it. And why is that happening? Mortgage rates. It's very simple. And it's not just new home sales that are crashing. It's existing home sales. U.S. pending home sales tumble for the fifth straight month as rates soar. After unexpectedly large drops in new and existing home sales, analysts expected pending home sales to also fall in March, only modestly though. And they did, dropping 1.2% month over month, worse than a 1.0% expected. And down 8.9% year over year. So again, people can't afford housing now. I mean, it was bad enough when interest rates were low. It was tough for people to afford housing. With the price of housing going up, not being able to save enough for a 20% down payment, banks are becoming a little bit more tight in lending. And you're seeing the housing market crack. And whether we see substantially falling prices, that should, I mean, obviously if the demand dries up, prices have to come down. The question now is, where is interest rates going to go? I mean, if the Fed has to battle inflation, are we going to see 6, 7, 8% mortgage rates? Back in 1980, the last time we had inflation like this, mortgage rates were 12%. Boy, what would that do to the housing market? How would you like to be a buyer of housing last year that paid $50,000 over asking price, only to see your house drop 30, 40, 50% in value? And we're starting to see it already. And inflation is hurting everybody. Whirlpool Corporation came out this week and said that they're having big problems with inflation challenges, getting supplies and getting the raw materials to build appliances. They said that first quarter sales decreased 8.2% compared to the same quarter last year. Their revenue was 14% higher, but their profits are much lower because of the cost of making their products. Company projected to spend up to $1.75 billion on additional materials because of the soaring commodity prices. And it's not just Whirlpool that's experiencing this, it's all corporations. Supply chain woes are continuing. Expect to see it get worse. What we've seen so far this year is just the beginning of the story. Just a shortage of a few items could evolve into hundreds of products that'll be short. I mean, just think about it. The shortage of chips, computer chips, preventing cars from being manufactured, and everything. Everything's a computer now. Your car has more computing power than the Apollo spacecraft did that went to the moon. Your cell phone, your iPhone right here, more computing power than the Apollo spacecraft that went to the moon. It's just mind-blowing. So chips are in everything, from your coffee maker to your TV to your refrigerator. Now, if you go to major retailers today, Targets and stuff like that, you'll notice that the stock levels are lower than usual. And there's some empty shelves. And it's getting worse. But most items are still available most of the time. That's the good news. But we're starting to see shortages now that are very, very concerning. You have a pet. Many pet stores are facing a shortage of canned pet food right now. There's just not enough sources of cheap chicken and turkey, which goes into a lot of pet food. We have a bird flu pandemic going on right now. There's a shortage of aluminum to make the cans. There's a shortage of factory workers to produce it. There's a shortage of truck drivers and shipping. So we have a shortage of pet food. You love your pet? You want it to stay alive? You see pet food on the shelves? Buy extra. There's another shortage in the country. You have a swimming pool? You like to swim? We have a shortage of chlorine. I didn't hear about this until just recently. This week I heard about this. There was a destruction of a manufacturing facility in Louisiana by Hurricane Laura a year or so ago, late 2020. And apparently this plant makes 40% of the country's chlorine tablet. Now, what's really ironic about this is the plant's being rebuilt. It's currently under construction. It was due to reopen this year, but those plans have been pushed back due to ongoing construction material shortages. You see how this compounds itself? So you have a nationwide chlorine shortage that could be extended thanks to a nationwide construction material shortage. You would say, well, what does construction materials have to do with chlorine? Well, here, this plant was destroyed. What's even more concerning than the pet food shortage, we love our pets, but we love our little kids better, right? There's a nationwide baby formula shortage, and it gets worse and worse and worse. And parents are freaking out and spending a good portion of a day going to store to store to store to find baby formula. One local reporter in southern Utah decided to check out the shortage herself. And when she visited a local store, she discovered bare shelves where baby formula should be. What a nightmare. Can you imagine having an infant and not being able to find baby formula for it? Scary stuff. Well, at least we have to be glad that it's better here than it is in Europe. There's a shortage of a lot of stuff in Europe. Tesco, which is a big supermarket chain in England, is limiting customers to 3 bottles of cooking oil. The Russian-Ukraine conflict has choked off the world of sunflower oil supply. So obviously, Ukraine, they make sunflower oil. So we're seeing buying limits now in Europe on a lot of different products. Russia and Ukraine normally account for 30% of all global wheat exports. But they're not exporting wheat now. They're not even growing it. Fuel's being used for the war effort, not for tractors. And people are, just trying to stay alive there. You have senators talking about worldwide famine coming. When's the last time you heard like a U.S. senator come out and say that a worldwide famine is coming? That's exactly what Senator Roger Marshall said this week. Did you just say there will be a famine in Europe in the next 2 years? Said Maria Bartiromo, host of her financial TV show on Fox Business. He went on to say this will be a worldwide famine. I think it will be even worse next year than this year. So if 15% of wheat comes from Ukraine that's exported, and they're having problems getting fertilizer, they're having tractors in the field, all the diesel fuel is going towards the war efforts, sure, there's going to be famine. And if there's not famine, shortages of food, whatever you can get is going to be so expensive. It's a perfect storm right now. How about gasoline prices? U.S. East Coast inventory is hit with supply shock ahead of summer driving season. Severe supply crunches have sent East Coast distillates inventories, including diesel and heating oil, to the lowest level since 1996. Gasoline stockpiles are at an 8-year low, the lowest they've been since 1991. Depleted stockpiles have sent diesel prices to record highs, and gasoline prices are hovering near all-time highs. This comes 1 month before Memorial Day officially kicks off the U.S. summer driving season. It's one thing after the other. Now, meanwhile, Biden came out a few weeks ago and said that we're going to release 180 million barrels of oil from the U.S. Strategic Petroleum Reserve, 1 million barrels a day for 180 days, ending just before the midterms, by the way. Now, this was supposed to lower U.S. gasoline prices because of the Putin price hike. Remember, it's all Putin's fault. But instead, Biden has been sending crude oil to Europe, not using it here in the United States to lower prices. So what does it mean? It means the summer fuel markets are going to be extremely tight, and gasoline is going to be even more expensive at the pump. Other headlines, economic headlines. Quote unquote, meltdown. Bank of America sounding the alarm on collapsing freight demand. Trucking demand is near freight recession levels, according to Bank of America. Shippers' outlook on rates, capacity, and inventory levels are matching attitudes not seen since May and June 2020, when pandemic lockdowns sent freight volumes into historic decline. Demand is down 23% year over year. Truckload demand. What does that mean? It means recession. It means a sharp, painful downturn in the economy. And the last 12 recessions were brought about or preceded by trucking recessions. So we got ourselves a serious situation now in financial markets, in the economy. It's getting downright scary, financial markets. At my firm, I've taken the measure. I've moved all our conservative clients 100% into cash and money market accounts just to get out of the way of this market. There's an old saying in the market, sell in May and go away. It's an annual ritual. It comes out every May. You hear that. You're going to see the financial media start saying that. I guess the reason why that came about is that it's dull in the summertime. Everybody's on vacation. People aren't working. They ain't going to Wall Street. The actual saying really was sell in May and go away and come back on St. Ledger's Day. And that was a holiday that came about in mid-September. But now it's been translated into Labor Day. But really, it should be sell in May and not come back till late October, because September is the worst month of the year for the markets. I think more than ever now, sell in May and go away and just forget about markets for a while is probably the smartest thing anybody can do. I mean, this crazy volatility that we're seeing here is just unprecedented. Unprecedented. Risky times. If your portfolio is overexposed to the stock market, you better do a reevaluation on what's going on in your life, especially if you're close to retirement. Like I said earlier in the program, I just can't believe the risk that people have taken. Just prior to retirement, the theory is the closer you get to retirement, the more conservative you got to be with your money. You can't come back from a 30, 40, 50% decline. But it's amazing how many people have 85% of their money in the market. And you know what? Many of them don't even know it. They don't even know it. I asked somebody, in your portfolio, what's your stock equity percent? And they look at me like, what are you talking about? Well, let me figure it out for you. Let me look at your statements. Let me tell you where you are. You're at 85%. You know what that means? It means your retirement is at risk. Because an old financial planning axiom And it's a rule of thumb, but it's not exact. But, you take 100, you subtract your age from it, and that should be your maximum portfolio exposure to stocks. So if you're 60, you should be 40%, not 85%. And that's in normal times. And just realize that, in a rising interest rate environment, stocks perform poorly. And I wouldn't be surprised to come into work one day and see a 2,000 point down day in the market, or maybe 3 in the Dow. Wow, we had 2 1,000 point declines this week alone. And the real panic hasn't set in yet. And looking at charts and looking at technicals, we're just seeing relentless selling. And we're seeing selling in stocks. You hear the Nasdaq's down 20% for the year, but you look under the hood and you look at the average tech stock or Nasdaq stock, you're looking, stocks are down 70, 80, 90%. And we're seeing highly paid money managers, they're going to cash. They're getting out of the market. Now, the big movers in the market over the last 5-6 years are the FANG stocks. That stands for Facebook, Apple, Google, Netflix. These stocks are all falling rapidly right now. We've seen what happened in Netflix. Netflix has plunged 40% in 2 days. And Netflix is down 70% since its high in October. Think about it, 6 months. Comes back to get woke, go broke, but we'll talk about that later. Well, this week, Treasury Secretary Janet Yellen said, I don't expect a recession. When you have these people talk, believe the opposite. Everything is a lie, right? Oh, inflation is transitory. Okay. Fed chairman in the past, Greenspan, Bernanke, both said the same things a few years ago, and sure enough, recessions were right after they said that. As a matter of fact, many times a recession was already in progress, and that may be true now. So just, again, be very, very cautious with your investments. It's a very, very, very dangerous time. All right, time for a break. 732-237-9626 is our phone number. You have any question on any money matter, we're here to help you on the financial position. My name is Lou Scatigna. Don't go.